Alright, so Forex market retracement and trading with Fibonacci. When learning how to trade Forex with Bull FX, the Fibonacci retracement tool will be one of the most important technical charting tools for your trading success. Now, I'm not going to go very deep into the theory of the Fibonacci sequence and what it represents. We will just be going into how to apply the Fibonacci trading tool to your trading and how to map out this tool on your technical charts in order to find selling and buying opportunities. Like I previously explained, we will not bombard you with a whole lot of excess information that will confuse you, because that's the trap that most prospective traders fall into when they are learning how to trade. What you need to know is where to find the money in the market, right? That is the most important thing. Unless you are out there creating algorithms for a bank or a hedge fund, and you don't really need to know where to find the money in the market, then by all means you can delve deep into the science and technicals behind and programming behind all of these various tools that are made available for trading. However, as traders, we are here to make money, and we need to find out how to make the money as efficiently as possible in the market. So that is why we just have straightforward explanations of how to apply these strategies and tools to your trading so that you can be as profitable as possible. Right? So Fibonacci is a technical charting tool that is used to measure the distance or percentage that a market retraces or pulls back after forming an impulse wave. The theory of Fibonacci suggests that when the market pulls back a certain percentage, you can then project to which level or support and resistance level the market will go to next in order to determine where you will exit your trade and bank your profits. Trades are entered at the point to which the market has pulled back or retraced. The Fibonacci tool is drawn on the chart from one swing point to another, normally from a low to a high or a high to a low. In an uptrend, we draw Fibonacci from a swing low to a swing high. In a downtrend, we draw Fibonacci from swing high to swing low. Once Fibonacci is presented on the charts, different percentage retracement levels will appear. These levels measure how far the corrective wave moves. According to Elliott wave theory, wave 2 should retrace to the 61.8 level on the chart, which is known as the golden ratio. Once reached and a valid reversal candlestick pattern appears, then you can enter the market at the beginning of the third wave. You can then trade until where the Fibonacci tool predicts the third wave will go, or the Fibonacci extension level that it is known as. This applies to both an up and down trend. Fibonacci levels can also be drawn on wave 3 as well, in order to measure the retracement of wave 4 and enter the market at the beginning of wave 5. You will again trade until the suggested Fibonacci extension level. There are different Fibonacci retracement levels to consider when trading. Below you will find a list of Fibonacci retracement levels and a list of the matching extension levels for each retracement level. More on the way we trade Fibonacci at Bull FX will be explained in the video where we will be putting everything together on how to trade the Bull FX strategy with an in-depth explanation of the Fibonacci strategy that we use. Right, so this table you need to keep into consideration, right? When a market retraces to a 38.2 level, the extension or the target to take profit would be a 138.2. If it retraces to a 50, your target would be a 161.8 or extension level. If it retraces to a 61.8 level, your target would be a 161.8 extension level. If it retraces to a 78.6, your target would then again be a 161.8 extension level. So how does this work when it comes to waves? So below we can see the Fibonacci tool drawn on a chart from a swing low to a swing high. So as you can see over here, we've got a swing low, and at this point we've got a swing high. So this is wave 1. Right, the market then pulls down to form wave 2 and moves up to form wave 3. Right? So once we've identified wave 1, we use the tool to draw it on wave 1. We would then do it from the low point to the high point, because as we can see we have identified an uptrend. So we would then take the tool, we would click on the low point, drag it all the way up to the high point, right? And then we would have the tool on our chart. As you can see over here, if I zoom in a bit, right, if I zoom in a bit, you can see that these are the different percentage levels of the market, right? The bottom from where you drew a tool from the swing low to the swing high, the bottom is the 100%, and the one right on top would be the 0. In between you'd have a 23.6, 38.2, 50, 61.8, and 78.6. Some traders have different other levels that they add onto this tool as well in between, for different other retracement reasons. Right, but for the basis of Fibonacci, this is what you need to know. So the tool will then be drawn from the swing low to the swing high. As you can see, this is the first wave. This is then done to measure the retracement of the second wave, or the corrective wave. So you can see this is the second wave over here, and it corrects all the way down to the 38.2 level, right? Whereby we now form a reversal pattern, right? This is a reversal pattern that forms. You can see there's a big clean bullish engulfing candle, and we've got a spinning top over there as well. So we've got a reversal candlestick pattern that forms on the 38.2, which gives us an indication that the market will now continue upwards again, after it formed this corrective wave. So this is where you would enter the market, then you would ride out the market all the way until a Fibonacci extension level, which would be somewhere over here. It isn't marked on this picture, but this would then have been a 1618 or a 138.2 level, like I had just previously explained in this table over there. So it says there, if it retraces to the 138.2, it will extend to the if it retraces to the 38.2, it will extend to the 138.2. So over here, it retraces to the 38.2, so it will then extend to a 138.2 level somewhere over there. When it comes to your standard settings of your Fibonacci on a trading platform, these are the only levels that will appear between the 100 and the 0. The other extension levels you would then have to add in on your tool. You would have to add in manually. That is why we don't have those levels displayed over there. However, I will show you how to add in those extension levels. So that's the basics of basic of Fibonacci. You would then draw it from the swing high, or the swing low to the swing high. See how far this corrective wave pulls down and to which percentage level it pulls down. See the reversal pattern it forms, find an entry in the market, and then ride the market out until the extension level, whereby you would then take your profits. Right, and that is it for the guide to successful Forex trading. Now we're going to move on to setting up our trading platform.